At its first meeting in February, the Reserve Bank had the cash rate on hold at 0.75%. The Big Four were under pressure to lower rates for borrowers, but razor-thin margins were holding them back. Unemployment was a little higher than desired, but forecasts were pointing to a gradual improvement. Little did we know how drastically conditions would change. When coronavirus began to spread, the RBA slashed interest rates to 0.5% in March, and then again to 0.25% in a spectacular out-of-cycle emergency meeting, the first of its kind in 23 years.
We started to see really serious turmoil in financial markets. We had, 3 Black Monday events, a Black Monday, a Black Thursday and a Black Monday that followed.
You can see a situation in these types of environments where you get huge falls in equity markets, and obviously the ramifications of those equity market falls into the broader economy and what that means for things like credit spreads and for the corporate bond market.
With the states locked down, higher unemployment was a certainty. In response, the RBA put its inflation targets aside and vowed its new focus would be to support jobs.
I think they have made a conscious decision to shift their rhetoric away from anything to do with inflation, talking about the need to bring the unemployment rate down and the size of the task around that. I think that's to really ensure that markets are clear that rates are going to stay low for a very long time.
Following the government's JobKeeper and JobSeeker initiatives, the RBA rolled out a suite of measures to inject liquidity into the financial system and aid Australia's economic recovery.
The RBA's decision to put a target on the 3-year government bond yield is a way to anchor inflation expectations, and it also anchors the expectations that you have for interest rates over the forward-looking period. For example, if the RBA is saying that they want to target the 3-year government bond yield, then financial market participants shouldn't expect interest rates to be raised for at least 3 years.
The RBA also created a $90 billion term funding facility for lenders.
If the cost of borrowing for the banks has been reduced, then hopefully they pass on those lower costs to their customers through lower costs of mortgages or business loans or personal loans. So it has this chain effect.
As the states managed to contain the spread of the virus, despite a second wave in Victoria, economists' expectations were looking up, but the Reserve Bank was still concerned, with its outlook implying further falls in employment. The RBA then reduced the cash rate to the ultra-low record level of 0.1% and officially launched quantitative easing.
I think what was highlighted by the November decision was how much the RBA and its policy was becoming pinned down or set by policy abroad. By not doing that, they were running the risk of a rise in the currency.
When people are locked at home, they're not doing much borrowing and spending, it kind of becomes a little bit worthless to try and do that type of policy. So once people were out and about more, the RBA thought that they could get more traction with doing further monetary easing at a time when mobility was actually rising.
The bank declared that it would purchase $100 billion in government bonds. By the RBA's December meeting, $84 billion had been drawn down by banks from the term funding facility, and the RBA's balance sheet had increased by $130 billion. Westpac is expecting quantitative easing to be extended in 2021.
We need to maintain that QE policy and match the QE policies that are still coming forth in the US and Europe and other global central banks.
Will rates go any lower? For now, the RBA Governor Philip Lowe says that's extraordinarily unlikely. In fact, the more interesting question is whether the RBA can stand by its commitment to keep rates lower for longer, especially given the increased likelihood of a vaccine-driven V-shaped recovery.
The only risks that I think will push the RBA to get there is if inflation comes in a bit stronger than anticipated, but I don't think it's a risk for 2021. The
RBA is still making it very clear that negative rates are extraordinarily unlikely in Australia, but they've stressed that if other central banks around the world were to move in this direction, again, they're going to have to match what's happening abroad.
Steph Nash, Sky News.